For those of you who don't know me, I'm Adam Myers and I lead the distribution team at Pengana. Thank you for joining us for our first webinar with Harding Loevner, the new investment team for the Pengana Harding Loevner International Fund. This business was established in 1989, and as you will see during this presentation, over the last 32 years, they have generated a track record of long-term benchmark outperformance with lower levels of risk. And they have done this by consistently applying the same investment approach since inception. They invest in high-quality, profitable companies that are experiencing faster rates of growth. Today, they manage in excess of $84 billion. Joining us on the call from Harding Loevner are the two portfolio managers, Peter Borton and Jingy Lee, as well as Kevin Ferguson, who looks after the institutional relationships. Russell, the Pengana CEO, will also join to provide some insights about the similarities and differences between the current and previous portfolio managers. Kevin, over to you.
I thank Adam, Russell, and Nick and the Pengana team for awarding Harding Loevner the opportunity to manage for Pengana's clients the Pengana Harding Loevner International Fund. I'd like to introduce my colleagues who will be speaking with you today. Peter Bond possesses 33 years of industry experience, 24 years with Harding Loevner, and is co-lead of the global equity strategy 18 years. In addition to his portfolio management responsibilities, Peter is also a global sector analyst covering consumer discretionary names. Jingy Lee possesses 16 years of industry experience, over a decade with Harding Loevner. He rejoined our firm in 2010 after interning with us as a summer intern when he attended business school. His analyst responsibilities include global industrial sector coverage, as well as all sectors within China, an important growing area of investment opportunity for our clients. You know, for 32 years, Harding Loevner has, as Adam just said, offered a consistent singular investment philosophy, which is to only invest in quality growth businesses while paying attention to valuations. We've been able to enhance our clients' global equity portfolios by delivering relative outperformance with less risk over the long term. This benefit is supported by several key attributes. I'll highlight two for you. First of all, our culture has contributed to organizational stability and low investment staff turnover. Certainly, our PMs and analysts' average tenure with our firm is 9 years, so very long standing there as well. Our culture is captured best by the phrase of collaboration without consensus, and our PM structure, which Peter will describe, brings that to life through a real life example. The second thing is our long-term approach characterizes everything we do as a business. Our portfolio turnover is low across all of our strategies, and our incentive structures have always aligned our interests as employees with those of our clients. Harding Loevner has been serving Australian clients for more than a decade. These are some of the most discerning and demanding clients globally. Australia certainly is a key savings market, and we're thrilled to be partnered with Pengana and the Pengana team to bring our capabilities in global equity to Pengana's clients and the fund shareholders. In a normal travel environment, we actually visit Australia a couple times every year and have done so for more than a decade. And in addition to that, we've always had a number of Australian investors visit our headquarters in New Jersey as they conduct deeper due diligence on our firm and try to understand what makes our culture so unique. We look forward to meeting many of you once travel resumes to a more normal level between our countries. So with that, what I'd like to do is hand it over to Peter, who'll get into the specifics of our investment approach.
Okay, thanks, Kevin. So as Kevin indicated, I've been doing this 18 years. So I'm in my 19th year of co-managing this global equity portfolio. And I absolutely love doing this because it is such a dynamic group of businesses that we spend all of our time focusing on. But I wanted to share two points that I've learned over the years, then I'll get into some of the slides. The first one is I've really come to believe that what we do is just common sense. In fact, I think of it as almost a rampaging common sense. Everything you're going to hear is just common sense. You'll see what I mean in a minute. And the other thing I want to say, it's simple. What we're doing here is very simple. I've come to believe and experience that. It's not easy. I'm not saying it's easy. It's actually hard to deliver the results year in, year out through different cycles, but it's simple. Our approach is simple. So let me begin with what kind of companies do we invest in? Let's go to page 9. So this is the kind of business that we focus on, page 9. Businesses that are demonstrably higher profit, more profitable and faster growing than the market, and businesses that have lower risk. And by lower risk, we mean standard deviation of ROE over a cycle is lower, and they have lower financial risk. There's nothing worse than having a market turn south, macro problems start, and you're not sure about your balance sheet, you're not sure about the cash flows, you're not sure about the contingent liabilities and all that stuff. We have strong balance sheets. So when we focus on profitability, you'll see businesses are higher profit margin, higher return on assets, higher return on equity. And they also have to grow faster. So we have higher quality businesses that experience faster growth. This is not a coincidence. This, by the way, what we're looking at is a cross-section of the equity portfolio, the global equity portfolio. This is what the companies look like. Our research process is designed to find this kind of company. It's what we do all day. We find businesses that look like this. We have about 475 of these in the approved list today. And the bottom-up portfolio construction from amongst these types of companies is what we do. And so when Kevin talks about a portfolio that outperforms, it's because we're bottom-up constructing stocks from a group of businesses that if we do our job right, they all look like this. And all we're supposed to do as PMs is construct the most compelling combination of securities that belong to businesses that look like this, managed for risk. So let me get to the second point. How do we go about constructing a portfolio? This is what we target, okay? This kind of company. Now, this doesn't make us that different. A lot of people have figured out this is a common sense way to invest. You can compound undervalued securities in these kind of businesses and generate a lot of wealth. Where we begin to get a little different is how we go about making decisions. And that's what Kevin talked about on the collaboration without consensus. So let's turn to page 6 for a minute. I'll show you the team. And the point I want to make about the team is this is a very diverse group of people. We believe in this fancy term, okay? It's cognitive diversity and shared values. Now, I know it sounds like a little bit of a buzzword, but it's really powerful. And what we mean is we consistently and thoughtfully and for 15, 20 years have gone out to find people with different backgrounds, different experiences, different nationalities, but the cognitive diversity, but shared values. We all believe in quality growth investing. And so the way we make decisions at Harding Loevner is we say, let's not make bad decisions. So let's not have an investment committee. Why don't we want an investment committee? Because we think by the time you need people to agree, if you have to get people in the committee to agree to buy something or to agree to sell something, it's probably too late. It's probably too late on the way up. It's probably too late on the way down. So what do? We demand and we enable individual decision-making. So that's the part about no consensus. However, we require collaboration. What we've all come to learn is that if we can have a debate with this group right here about an idea, we will individually make better decisions on the backside of that debate than before that debate. And Gingy will go through the investment process. And on page 15, you're going to see the common language that we have put in place as our analytical framework and as our debating structure. And so when we make decisions, Ginny or I or any of the other PMs, we can make independent decisions, don't need to have anybody agree with us, but we can only make the decision after running through a disciplined debate through a structured common language format with this group, with the research group. And what we've learned, and what I've learned time and again, is that my decision-making is better, individually, transparent, compensated, post-debate than without a debate or within some kind of consensus-oriented investment committee. Let me mention this one other thing. Let's go to, I think it's page 9. Page page 8. Direct ownership. While I'm speaking, you can look at some of the edge. Direct ownership. You know, the third point I think is common sense at Harding Loevner is we become owners of the business. I'm a partner in the company. Ginny's a partner in the company. Kevin's a partner in the company. We have direct ownership in an asset management business. We have an owner mentality. It's hard for me to sell my stock. There's lockups. I have a meaningful, a very, very large personal investment in Harding Loevner, as do my partners. We are direct owners in the business. And what I've learned over the years is if you want to tie in interests of employees, partners with clients, typically we have clients here 5 years and more, portfolio average holding period 4 years or more, we tie it in through direct ownership that's meaningful. Lastly, let's go to the ESG page, page 10. The last thing I think we do, which is terrifically common sense, we have common sense with the kind of companies we look at, common sense the way we make decisions, common sense in direct ownership, common sense in how do we integrate ESG? How do we do sustainable investing? We look at everything as a risk. ESG risks are just as much as in our analysis as any other risk. And it's integrated tightly into our investment research by each industry analyst. And when we engage with companies particularly to talk about ESG risks, but also every other kind of risk that we identify. Finally, what does all this deliver? What's the deliverable? And what's the long-term record? So let's go to the next page. And I'm going to close with this. I'll hand it off to my colleague, Ginny. This is what the output has been from this kind of high-level qualitative characteristics I'm trying to communicate to you. If you think about the type of businesses we look at, how we go about making decisions, how we motivate and tie people in terms of incentive and motive with ownership, how we do integrated analysis across the risk spectrum, we have delivered a very particular track record. It has a predominance of outperformance in single-digit market returns. Okay, so what's that mean? We're looking at 5-year rolling returns since inception. And what it's showing you is that in 95% of the market of the time, when markets have delivered single-digit returns, this portfolio has outperformed. It's showing you that it happens to be in 57% of the double-digit markets. This portfolio has outperformed. Overall hit rate 82% as per this chart. These are gross returns for comparability. We can publish in that. What's the punchline? The punchline is that in single-digit markets, the blocking and tackling, bottom-up analysis, valuation, diversification, strong businesses that we are all about, those stocks outperform. When we have strong double-digit markets, those are frequently periods characterized by stimulus, by turning points in economies, and you'll frequently see securities of what we consider to be lower quality, highly levered, less structural growth businesses. Those securities can rocket, slingshot ahead. We can't always keep up with them, those types of markets, but 57% of the time we have. So the way I think about this, if you think about the next 5 years or so, whatever your investment horizon is, are you expecting, frothy, what I would call frothy double-digit markets, or more of a single-digit market return from here? That's how I would thinking about us for the future. Let me turn it over to Jingyi to talk about what's under the hood, what's underneath all of this with our investment process.
Thank you, Peter. In the next few minutes, I'm going to walk through our investment process and to show how we implement this very simple idea to deliver results. If you look at page 13, this is an overview of our investment process. It's a very straightforward process. We started, just 4-step, you can call it a funnel. Start with a qualification, starting from like thousands of the company, zooming down to a couple hundreds of potential candidates, and then we do a deep dive and research and rate stocks, so that within our pool, there are 475 companies that are vetted and rated by our analysts, and our portfolio manager can only build a portfolio based on from the stocks that they now are rated pools. So this is a simple process, but it is applied rigorously across our strategies, being global, international, EM, the same process has been rigorously implemented throughout the past 30-something years. So one step at a time, let's start from the step one. As you can see on page 14, we start from qualification. So when, remember we talked about our goal is to invest high quality, high growth company. And we break down that goal into 4 key criteria: strong competitive advantage, sustainable growth, financial strength, and good management. It's a very straightforward idea. And then on the right-hand side, you can see a screening tools that we use. Let me spend a minute to explain this. It is a proprietary tool developed by us. So we call it a bubble chart. So basically, we rank each and every single company in the universe based on the quality and based on the growth. And we gave them each company a number, a ranking number against every other company in that universe. So, then you plot each company on that 2x2 chart. We call it a bubble chart. For this particular chart is actually focused on a very interesting sector, healthcare, a target-rich area for quality growth manager like Harding Loevner. And you can see that some of the bubbles company show up on the upper right-hand side of the chart. Those are the likely to be high-quality, high-growth company, and there are a handful of them showing on the lower right. Those are the high-quality but low-growth company, and on the lower left-hand side, obviously, those are the company that are not only low quality but also low growth. So our analysts look at this chart, have a rough idea on the quality growth characteristics of potential companies. And just want to add emphasize one more point, that this is a highly objective rankings. These formulas developed by us only incorporate historical data. Does not listen to sell-side pitch. Does not listen to companies' presentation. It's based on historical numbers. Those are hard facts. So these are history facts that plotted on this chart. Let's say that an analyst look at this, based on experience or based on this initial screening, and decide to take a deep dive, look at one company, and then let's start from the next slide. So in this particular case, let's use a company in our portfolio called Thermo Fisher. Some of you may know that it is a very famous sort of tool provider in the life science industry. So our analysts may spend anywhere between 3 to 4 months, or maybe 6 to 9 months to walk through these 4 criteria I just mentioned. But this time, take an even deeper look, break down each criteria into more details. Under competitive advantage, you can see that we break down to 5 bullet items. Some of you may recognize that just the Porter force, 5 forces. We use Porter 5 forces extensively at the Harding Loevner. That's our common language. Common language, not just English, but also sort of analyze each and every single company based on these Porter 5 forces, repeated again in every single companies. And the sustainable growth, financial strength breakdown, and quality management, ESG breakdown. So break down those 4 key criteria into 10 QA scores. Each analyst had to rank the company based on a scale of 1 to 10. Was it strong on barrier to entry, on growth, on the management. And behind this, each scores, an analyst has to write a full analysis to substantiate their ratings. So this is to follow a standard template at Harding Loevner, so all analysts can follow the same structure covering the company in an extensive way. So after finish this a deep dive research following the standard template, and we start to move on to the next stage. You may notice that until this point, we focus on the business. We have not started to look at the security yet. On the third step, we start to look at the valuation of the security. So turn on to next slide. So again, we use a standard DCF model to evaluate the company's valuation. I can see that we build a full DCF model, usually looking out 10, 15, even 20 years based on our analysis, based on our forecast. And we use sort of a slightly enhanced version of DCF, the cash flow return on investment, a concept very similar to DCF as an engine of a valuation mechanism. And after all this exercise, an analyst need to call we call it a research meeting. Basically, it's like a peer review process. You remember, Peter and Kevin talked about sort of our firm follow the same philosophy in a very structured way. And I'll also mention that we speak the same language. That's the beauty of that. So we each analyst take the individual ownership to start this research process, but they have to collaborate. Because we use the same platform, speak the same language, we can review each other's research work. So we critique each other's research work, give feedback as peers. So only after the peer review process, right? So that's the collaboration part. Then go back to the collaboration without consensus part. It is the analyst's sovereignty or discretion to move ahead, decide to rate this company, either buy or sell or hold. And this decision, this recommendation is tied to this analyst's own performance. It has nothing to do with if everybody else agree with that recommendation or not, if nothing to do with whether PM buy this security into that portfolio or not. So the individual accountability is very, very clear. After this step, we will, analysts are supposed to continue to maintain the research work, the research, the coverage, as the company showed, quarterly results or major strategic events. But at this stage, this company is officially admit to a pool of, 475, roughly stock that's been vetted and rated by our analysts. So at this stage, it's ready for PM to pick from that pool of company. So before I hand it over Peter, I just want to emphasize one last point. So this is a highly structured way. Every analyst at Harding Loevner, being an industrial analyst, being a healthcare analyst, being an energy analyst, we all follow the same structure, and we implement the same process, same philosophies. So when the company passes through this process, it definitely meets our quarterly growth standard and ready for PM's portfolio construction. With that, I will hand over to Peter. Hello, Peter.
Good. Let's go to the next page. Thanks, Jingyi. That was great. The next page, page 18.
Peter,
So,
will you switch back your video?
It's on.
Oh, there we are.
Yeah. So as Jingyi talked about, we just went through a process that in aggregate generates an approved list of companies that's currently about 475, as Jingyi indicated. They all tend to have that high quality, durable, sustainable growth, superior growth footprint I showed earlier. And now the opportunity, the challenge is, how do you get portfolio managers to find the most compelling unmonetized insights in the group and put them into a winning portfolio. And so this is, again, where we have no consensus and we have required collaboration. So let's say, let's talk about Thermo Fisher for a minute. It comes through the process. It's a compelling healthcare tools company. Jingyi and I, as well as the rest of the research team, will have participated in the discussion and the debate around that tool. We call the research report a tool, and it gets written electronically. We debate it, and then there's a meeting. We debate it, and we all go through those quarter forces in common language, debating back and forth. So we're already familiar with the business. And the question that Jingyi and I have as portfolio managers is it undervalued? Is it additive to our portfolio suite? And the way that a portfolio manager can add a name from that approved list into the portfolio is through written invitation. If I decide that I want to add Thermo Fisher to my half of the portfolio, I have half the capital, Jingyi has half the capital. I write an email to Jingyi, copy to co-PMs and the paper PMs, which are some internal kind of competing PMs that we've set up, as well as the CIO. And I say, Jingyi, I'd like to buy Thermo Fisher for these reasons, which will rarely be a surprise because it's already been debated transparently across the research group. Do you want to participate? I have to invite him in writing to participate, because the idea here is let's get best thinking to float to the top and drive decision-making. So I say, this is my best thinking. I think, and he has 24 to 48 hours to respond in writing, yes or no, and frequently why. And so I invite Jingyi to come along, and I am not allowed to buy that security until he responds within that time frame. And if then I have the stock in the portfolio and I wish to sell it, the whole thing has to go in reverse. I have to write an email to the same group and say, Jingyi, I want to sell Thermo Fisher for these reasons. Could be valuation, could be deterioration. Do you want to sell yours or buy mine? And this is how we build the portfolio. My half of the portfolio is 100% securities that I alone have decided to buy, with nobody forcing me, no necessary consensus. And it's 100% my responsibility. There's nobody I can point to say, that was your idea. I didn't own it. I own it. I'm 100% responsible for my half of the portfolio, which is a diversified portfolio. And I'm compensated on that. Jingyi is 100% responsible for his half. He can point to nobody else. It's on him. Of course, his decision-making is enhanced by everybody else, but it's on him. The CIO, of course, is compensated for the total portfolio. That is how we go about constructing portfolios here. We call it co-PMs, and that's what our collaboration without consensus is. And that's how we have developed over 30 years, which we think is the way to bring optimal decision-making to portfolio construction. Let's talk about risk management. Next slide. So I'm going to come back to the common sense theme for a minute. This is how we've managed risk here at a high level for 3 decades. We require that we have a minimal spread of diversification of businesses by geography and industry type and position size. So we can't have more than 5% in one name. We can't have more than 25% in one sector. So currently the technology sector, for example, I don't know, it's 22% of the global benchmark. You will not see a Harding Loevner portfolio with more than 25% in any one sector. Therefore, you will not see us with more than 25% in technology. Some investment firms will have 40% in technology. They'll have 10% in one name. That's not how we run our portfolios. We limit them to 25%, as you can see, in any one sector, 15% in any one industry group, for example, software within technology. We require a minimum number of sectors, in this case 7, and we require a spread across the geography as well, and a maximum position size in each security, maximizing at 5%. Let's go to the next page. So we think about risk management here, it's very much at the security level, on the individual focus on quality and growth and the rigor of the research that Jingyi was talking about, portfolio risk, enterprise risk. The firm Harding Loevner is run exceptionally well. There's never been a problem in our history with audit or any operational due diligence. The firm is run exceptionally tightly and conservatively as a business. That's about it for the presentation. If you go to page 22, you can see the portfolio structure at end of Q1. Healthcare, it remains our largest overweight. It's been our largest active share in recent years. It's our largest source of outperformance in recent years. You see it's followed really by financials overweight. If you look at our Q3 WebEx last year, we did a bit of a deep dive into financials and why we own them as a quality growth manager. That was before the vaccine. So it's unusual for us to be overweight in financials. I think this is the third or fourth time in the last 20 years we've actually had an overweight weight. The reason we're overweight financials is because they got beaten up so badly in the years prior to the pandemic, during the pandemic, that the relative handful of quality growth financials that we follow became attractively valued enough to own. And so that's where we get the overweight in financials. And you can see the dispersion across sectors, and you can see the weights by region. On the next page is really what the top 20 holdings are, and maybe we could open it up to see if there are any questions at this point.
Fortunately, we have received a few questions already, so I'm going to start with the first one. You showed a slide on ESG incorporation. Do you see ESG as a risk mitigant, a source of return, or simply a requirement of modern day investments?
Well, in my view, it's been a risk mitigant since day one. The reason we do this analysis is to identify risks to long duration cash flows. As you may have inferred, this is all about duration for us. We have average holding periods of 4 years. We have quality growth businesses where we do fit 10 years at minimal, typically in terms of our forecasts. We need businesses where we can confidently forecast a long tail of above average earnings growth rate with good returns on capital. It's all about risk mitigant. ESG is a risk mitigant. It's nothing else really. Jingyi, would you add it? Do you have anything to add to that?
Yeah, so I fully agree with Peter said. Our company generate above cost of capital returns, and the question is whether and how long these company can sustain such a high profit level and a high growth. And ESG is one area that we pay a lot of attention. Is actually a basket of risk factors we pay a lot of attention to, and to evaluate whether any risks can jeopardize the longevity of this growth. I just want to mention that we think about these individual risk items even well before there's a term ESG. As the investment community start to pay more attention to that, we start to group them together just to make it more easier for people to understand. So it's now grouped together and it's called ESG factors. We have done that for many years, and so that's one thing I want to add. Another is I would say that in certain areas like climate change, in recent years, as the global community start to take more actions along those initiatives, they become some of the initiatives become an area that pops up in our growth analysis. So these initiatives start to drive some of the growth as a growth driver. But as Peter said, our primary focus on ESG analysis is risk mitigation. Back to you, Adam.
Thank you. I have received a number of reminders that Russ was going to chat a little bit about the comparison of this strategy or of this management process to the way the strategy was previously managed. So Russ, can I invite you to join at this point and just cover some of the similarities and differences between the two strategies?
Thank you for joining today's webinar. As CEO of Pengana Capital Group Limited, I'm extremely pleased that we have been able to secure Harding Loevner as our partners to manage the Pengana International Equity Fund. In order to find the optimal team to manage the fund, we conducted a worldwide search assisted by one of the large global asset consulting firms. The brief that we provided had 5 key requirements. Number 1, a long-term track record with a history of significant outperformance of both the benchmark as well as competitor funds. Number 2, a track record of outperformance in down markets. That is a strategy that outperforms when equity markets actually fall. Number 3, an investment team that is highly regarded by the asset consultant community with a super A-grade clientele list. Number 4, strong ESG credentials that are embedded into the investment process. And finally, a team that is culturally aligned with the wider Pengana business. Although we were presented with a short list of half a dozen great fund managers, Harding Loevner was clearly the standout candidate to manage the fund. The strategy on this slide shows the returns of the Harding Loevner strategy since inception 32 years ago, and the substantial outperformance of the benchmark over this period. I note that the actual Harding Loevner track record was in USD, and that we have converted it into Australian dollars in order to make it more meaningful for investors. In addition to the significant outperformance, I also draw your attention to a previous slide where we showed the upside and downside capture ratio, which shows that Harding Loevner has captured 110% of the market upside, whilst only suffering 92% of the downside. With a 32-year history, this outcome is highly statistically significant, proving the effectiveness of both the strategy and the team. We have received a number of inquiries from investors about how the Harding Loevner strategy has performed relative to the previous strategy that the Pengana International Equity Fund employed over the last 5 years. The slide on the screen is separated into 2 parts. On the left-hand side is the stated net performance of the Harding Loevner strategy relative to the benchmark. And on the right-hand side is the fund's previous strategy, also relative to the benchmark. Importantly, both strategies over all time periods outperformed their respective benchmarks, generating alpha for investors, which was a very good accomplishment in some pretty difficult markets. The outperformance of the Harding Loevner strategy was, however, materially higher over all time periods, including the generation of a 3.1% per annum alpha over the most recent 5-year period, compared to 0.4% for the previous strategy. As you know, we always state that past performance is not a reliable indicator of future performance, and so should not be used for these purposes. Nevertheless, we have provided this analysis as we know that this is something that is of interest to investors. The pie charts on this slide show the difference in portfolio composition of the Harding Loevner strategy and the old strategy. As you can see, there are similarities as well as some quite significant differentials. However, in our view, these differences should not be overstated, as this is only one snapshot in time, whereas in actuality, these exposures have changed significantly over time. This is because both strategies have flexible mandates that enable them to alter exposures under different conditions, which is certainly something that we look for across our offerings. I'll now pass back to Adam for the Q&A to continue with the Q&A segment. Adam, over to you.
Thank you, Russ. Kevin, we have a number of questions around the transition of the portfolios from the old portfolio to the Harding Loevner model. Can you please talk a little bit about how that transition has been managed and where we stand at the moment? You're on mute.
Yes. Thank you for the question, Adam. The transition is well underway, and we've been fully keeping the Pengana team updated throughout the process as we transition. This is a very liquid, ours is a very liquid portfolio, and we're very careful on the transition. The investment team members are in close consultation with our trading team, as well as our client management team, to ensure a positive, good outcome for investors in the fund.
Great, thank you. And from a currency management perspective, can you comment on the approach?
Sure. We actually do not hedge currencies. We do not actively manage currencies, and a simple reason for that in that we are very much a long-term investor. As Peter mentioned, average holding periods in excess of 4 years. And because of that, we want to take the diversification benefits and own the diversification benefits by not hedging currencies and actively managing them. Perhaps Peter or Jingyi would be interested in commenting there as well.
No comment from me. That's exactly the game plan and the experience.
Thank you.
Great, thanks. I have another question here talking or asking about how you would typically perform during value rotations. We've seen a very strong value rotation recently, but it's not the only time. How have you performed now? How do you typically perform during such periods?
Well, if you go back to that slide that we showed, the rolling 5-year returns, there were some dots below the line. Some of those were 0203. I just began being a PM back in February 03, but I can remember we will lag. If there is a significant style headwind, we will lag it. Let me be clear. We will do whatever we can with foresight and diversification, and we do have a diversified quality growth portfolio. But if it's a significant style rotation toward outperformance of companies whose characteristics tend to be highly levered, had not been historically rapidly growing, their growth is contingent upon macroeconomic enablers. They have a lot of leverage sometimes, and the market's seeing that they may be able to refinance, and these securities move. We will lag, and that I can think of 2 or 3 periods in my 19 years when that's happened. We will not chase value unless it's a quality growth name that's less expensive than others. We will not kind of change our spots, if you will. We will patiently accumulate securities that are getting increasingly attractive of structural growth businesses. And what we've seen over the history is a very strong outperformance and catch up when that style headwind shifts. That's not to say we don't think about it. We don't try to anticipate it. We have increased exposure in the portfolio to energy and to financials and to some less expensive looking consumer names over the prior, really in Q4 and Q1, in anticipation of potential changes in market dynamics. But we will lag for the period, depending on how strong the rotation is. That's been the experience. Jingyi, do you want to add anything?
No, I don't have much to add. And this is, we talk about style factors in every single quarterly presentation, break out the market performance by quality, by growth, and by value. And we have been telling our investor that for a pretty long period of time, we've been enjoying a style tailwind. And we also have been telling our investor for many, many years that we expect one day we will face this tailwind will shift, and when that happens, we will face a style headwind. As Peter mentioned, that we may position our stocks, a few stocks, if they meet our quality growth standards, to increase the diversification of our portfolio. But we will not change our quality growth philosophy, and just we'll have to face the period of underperformance.
But I want to say, I think this is a feature, not a flaw. We're investing long term here, and we have a lot of our own money invested in the portfolio. I love it if we're seeing strong business results of our companies being met with shrugging of the shoulders or sideways movement for 6, 9, 12 months in share prices, because they're coiled springs. They're storing up future energy for outperformance going forward. Our businesses are strong and powerful, and if the security prices of those companies are not keeping up with the underlying growth and fundamentals of the business, it's really a coiling spring. And as I said, I think a lot of companies that have been outperforming recently, their performance is really highly contingent on a whole series of macroeconomic developments. A lot of our businesses, it's not the case. They're contingent upon capital allocation and foresight of industry leaders with innovation and structural growth across the globe. So, you know, I think it's a feature, not a flaw, that will have a lag potentially in there. I get excited about it. It's pricing gets better and better, valuations get more attractive. So you got to be patient.
Just to add one point, you know, we talked about this slide earlier. You know, if you turn to slide 9, we show the quality growth characteristics of our portfolio. One of my favorite numbers on the far right-hand side, you can see that our portfolio's cash flow grow significantly faster than industry, the benchmark average. Just imagine this strong, well-managed company generate strong cash flow and compound themselves year in, year out for an extended period of time. The significance is much, much bigger than whatever style headwind, you know, tailwind, headwind that may cause. So this is the long-term compounding effect, long-term, you know, value creation of our underlying business. So this, you know, if we have any confidence in our quality growth philosophy, that's probably one of the areas that I found particularly powerful. So back to you, Adam.
Great, thank you. That was a very comprehensive discussion. Appreciate that. We've had a couple of questions relating to currency management being a deviation from the way the fund previously was managed. So I'd just like to respond to those briefly and say that one of the consistent sort of issues that investors used to have with our strategy was that it was difficult to place it in one bucket or another, that it, you know, if they were allocating, they would prefer to have a hedged bucket or an unhedged bucket. And so that's one of the reasons why we're very happy with Harding Loevner's approach to currency management and leaving it completely unhedged. The allocators are then able to, you know, manage it to the appropriate bucket. So just to respond to that question, another question around dividend policy, that policy has remained unchanged. We will continue to pay out the realized capital gains and income as they are generated. So that will be how dividends will continue to be maintained. I have another question here about frontier markets. Peter, maybe you can respond. Do you have any exposure at the moment, and what do you see as the opportunity set?
Well, I don't believe we have exposure, unless Jingyi corrects me, but I've been disappointed with Frontier, frankly. I was pretty excited about the idea. I thought they were going to be the emerging of the emerging, right? I've been disappointed with emerging for a decade. I'm disappointed with Frontier with an emerging. I don't think they're very interesting quality growth companies from what I've seen. I don't see every single one of them, but there are cement companies and banks and juice companies, and you know, I like technology leadership and secular growth healthcare companies with global addressable markets and intellectual property, you know, patents and things like that, on large total addressable markets with low penetration and high marginal profits on capital allocation and all those things. You know, in Frontier, it's hard to find that typically. Jingyi, have I been unfair?
Yeah, so we, you know, back to our core philosophy and process, we look at everything in a quality growth lens, in a portfolio structure lens, you know, and we don't have any sort of a top-down view. So we want X percentage in this country or a Y percentage in that market. One thing I should mention earlier is our analyst is really the hero, the driver of our portfolio. So if an analyst can find many high quality, high growth company from the frontier markets and get into the whatever 470 names that in our vetted pools, you know, inevitably some of the frontier stocks business will get into our portfolio if the valuation become attractive or not. And so far, you know, we have a dedicated frontier teams, but so far we have not seen that many compelling quality growth companies and with certain liquidity hurdle that meets our criteria. So that just our process sort of made a decision for us. So there's not much for the PM to think too much about it, and we don't have to, again, we don't have to sort of think about, oh, I need frontier, I need Japan, I need US. Our analysts are just presenting investment opportunities for us, and then it's a PM's job to construct the most compelling portfolio based on these recommendations. So now right now I don't see too many frontier stocks that could get into the portfolio. We do have quite a few emerging market, and some of them are small emerging market from small emerging markets once they meet our criteria, but not much frontier.
Great, thank you. Next question, a number of Chinese companies in the portfolio. Can you comment on your current assessment of risks with regard to investment in that region?
Yeah, so I'm, as Kevin mentioned in the very beginning, part of my responsibility is also our China specialist. So I follow quite a number of Chinese companies together with two other colleagues who are dedicated to that. So it is a very topical question these days on the regulatory issues. I can go on for hours on that. But the short answer is that one is we have a number of Chinese holdings in our portfolio. They are pretty diversified. You have holdings in sort of well-known internet companies. You have some of the sort of large but not so household industrial companies, or even one utility company that are growing nicely. So it is a very diversified holdings, even resuming to our Chinese holdings. So all these days, a lot of investors focus on one particular area, is the regulatory pressure on one particular industry, like e-commerce or internet, or even one or two large Chinese internet companies. We use our Porter analysis to analyze that. We come to the conclusion that the regulators want this industry to stay on the healthy trajectory. They definitely don't want to ruin the industry or the company. And looking at those specific company, they operate in a very, very compelling Porter structure run by a very capable management, and their cash flow is strong and the balance sheet is strong. So they have to rectify, or they have to adapt to regulators' expectations, how to make this industry more healthy for the longer run. But I appreciate what the regulator wants, and probably this management, these companies also fully understand what the regulators want for the longer run. So I can totally see that these companies can stay on the pretty sustainable growth trajectories, even they have to spend a few quarters to adapt their business model. But more importantly, outside this one or two companies, we have a handful of other companies that looking through our Porter structure lenses, quality growth lenses, they also stay on the very favorable quality growth trajectories with different policy dynamics. So as a whole, I'm pretty happy about what we have in our portfolio.
Great, thank you. Next question, how has the Indian banking exposure performed through the crisis, and what is the short-term investment thesis there?
Well, the Indian bank, we've owned HDFC Bank, which is, if you see quality growth investors in banks, my guess is you'll see HDFC Bank in India, you might see Bank Central Asia and Indonesia, in the US, Silicon Valley Bank and First Republic Corp. I would say those 4 banks that I've just mentioned are the highest quality growth banks that I know of. I'm not a banking analyst, but these banks are delivering double-digit growth over time with high returns and absolutely de minimis asset quality issues over cycle. So when we look at India, I don't look at anything short-term, particularly around COVID. The Indian banks corrected sharply. It was as COVID began, they rallied. HDFC Bank rallied to a new high very, very strongly as the COVID wave was dissipated. There's been a 15% correction probably as there's this ugly new wave has come about. I don't know how bad it will get with this new wave. I don't have that crystal ball. Nobody does. But I am pretty confident in one thing, that HDFC Bank is going to end up with a greater share of industry profits on the other side of this than they have today. As you're probably aware, there's been a long-term trend of the high-quality private banks, of which HDFC is the leader. ICICI Bank is kind of perhaps closing the gap along with Kotak, I think. But they've been outperforming the big state-owned banks because of the risk management cultures, the digital leadership, and et cetera, and the low cost of funds and the strong net interest margins, and of course the low penetration across the country of banking services. And so, as this COVID roils the economy, banks with poor loan management cultures and poor risk analytics systems are just going to have a heck of a time. And it's going to be ugly. And I think at the end of the day, we're going to see accelerated gain in growth and share in total industry profits for HDFC Bank. So I'm a buyer of HDFC Bank on any meaningful weakness. The problem is when it was at a record high, which wasn't just a couple months ago, the premium over the local gets fat. And so you got to be careful on how much we own when it gets too expensive. But long way of saying, yeah, it's a core holding, and I think it wins, and I don't have a short-term thesis on anything in the portfolio, frankly.
Thank you. So thanks everyone for joining us today. We have received a number of other questions about the transition. So just to inform you that the portfolio is now 95% transitioned. The trading has been done at VWAP, almost no slippage. So it's been a very seamless transition already. And as I said, it's almost 95% done. We have run out of time, but I haven't answered all of the questions yet. So any questions that we didn't get to, we will answer those. We'll get back to you directly and answer those questions. Thank you very much for joining us. This is obviously only a first introduction, but I hope that the information that has been shared today gives you a taste of why we at Pengana are so excited to partner with such a prestigious and high quality manager. Thanks also to the researchers who dialed in. Obviously, research ratings are critical, and we hope to have the fund rated soon. And the independent researchers who are putting portfolios together, thank you very much for the time that you've taken. If you have any other questions, please get in touch. Thank you all for your time and have a good day.